I know that you just addressed on Facebook Live a misconception that people have about this 1% rule. I got to
Yeah.
be honest with you. I'm not Mr. Educated out here. I don't really know what the 1% rule is, but if you could explain what the 1% rule is and why people are misjudging that and how to factor that into your rental income property decisions.
Absolutely. And before I get there, I saw Vinay had a question. It's a really simple answer. They asked how they could see more pictures for our properties on our evaluations. Vinay, I would encourage you go to JWB, because one thing we do when we get on the phone with you and we actually walk you through what the property recommendation process is, we have virtual tours where you can see exactly how.
Your audio was a little bit off there, Greg, for a second.
Oh,
Maybe
really?
just say that again. Yeah.
Okay. Well, we have virtual tours where you can see, you can walk through our entire homes and actually see how they look virtually. Like you can do like a walking tour. And so we make those available for you. These are all available, of course, for you. We would recommend investment properties for you and for you. So that's all available for you. We don't have it on the website. We don't keep inventory on our website. We have those property recommendations there as a great way for you to get kind of, in the know here. But then go to chatwithjwb.com, and that'll be available for you. I think it would be a great learning tool for you, Vinay. Let's talk as we're walking away here. I know it's getting to 1:30. The 1% rule. The 1% rule is something you may hear in blogs or in forums. The 1% rule simply means that for an active investor, the theory is that you should only buy properties that rent for 1% of your purchase price or your cost base. So to keep the numbers simple, it's 1% of a $100,000 purchase is $1,000 a month. So the 1% rule, active investors out there would say, I shouldn't buy a rental property unless it achieves this 1%, and I shouldn't pay more than $100,000 for a property that rents out for $1,000. And the thing about the 1% rule is the way to achieve the 1% rule means that you have to buy properties way under market value. And the problem is that investors like us who want to be passive might be reading on these blogs that, I should be following this 1% rule. And what they're not taking into account is the incredible amount of time, money, risk, energy that you need to put in order to find undervalued properties. But you're not going to find undervalued properties by being a passive investor. And that needs to be taken into account with this 1% rule. So in order to achieve 1% rents to purchase prices, you're going to have to put a lot of time and energy into it. You're going to have to put a lot of money into marketing towards undervalued properties, right? You're going to have to put, those, you ever seen those We Buy Houses signs out there, Pablo?
I have seen those.
Oh yeah, we love those. Think about you going out there on the street corners and putting those signs out, by the way. I used to do that back in the day. And I would go out every Friday night. This was Alex and myself, my business partner, Alex and myself. We would go out on a Friday night. We'd load up with like 200 bandit signs, and we'd go and drive those and put those out at like 2:00 on Friday because we didn't want to get caught and it was not exactly allowed. And then we would go back and pick them up on Saturday after we would get hundreds of phone calls, and those would turn into undervalued real estate. So, if you don't want to do that, right, if that's not high on your priority list, these are some of the things that active investors have to do. You might spend 6 to 9 months, negotiating, finding your first deal, putting it under contract. Financing is not nearly as easy. You got to buy it with your own cash, or you at least have to finance the repairs with your own cash. So think coming 50 grand, 75 grand, maybe 100 grand out of pocket. Fixing the property is something you're going to either do yourself or you're going to manage a contractor, neither of which is fun. So these are all of the active activities that go into being an active investor. And this needs to be realized in the equation, right? So this 1% rule is a great rule if you're an active investor and you want to do that. If not, it's misleading for passive investors, because here's the real deal. You don't need 1% of rents to hit positive cash flow, right? We were just talking about how you can hit positive cash flow in Jacksonville at 0.65%, right? It just doesn't sound as smooth as the 1% rule. It's the 0.65% rule, right? But it's positive cash flow. It pays for itself every single month, right? And that's really what you need as a positive cash flow for a passive investor. And it's a shame when these conversations are not taken into account all the time. Money, resources, risk that's taken on by an active investor. Pablo, you remember my walk and talk last week where I was talking about how the risk of buying properties actively came to bite JWB?
Oh yeah.
Remember that one?
Yeah, I remember that. Yeah.
How much money did we lose on a property just a couple of weeks ago?
Was it 150 grand?
Not that much. That makes me feel better. It wasn't 150.
100 grand?
It was only $100,000
Ah,
that JWB lost on one property because we were dealing with title issues, and it was buying a property at auction. And these are some of the strategies you would need to put into place to buy undervalued real estate. So there's a tremendous amount of risk. So on the passive side, you don't need to take that into account. Are you going to get 1% rents in a growth market like Jacksonville? No, you're going to buy the property at market value, and it's going to be positively cash flowing. And you shouldn't feel bad about that. I mean, what other investment classes out there allow you to buy assets that even pay for themselves every single month, right? In the stock market, you put money in and generally you don't get money out on a monthly basis, right? And you don't get financing. That's such a great deal. So anyways, that's the deal. The 1% rule is misleading to passive investors. It's not something you should pay a whole lot of attention to. The real shame is when people get so fixated on that, they go to a market that is known to appreciate at a very slow rate because they're trying to get closer to that 1% rule. So you might look at Kansas City or Cleveland. I tend to pick on those a lot, right? You're not going to get to 1%, but you might get closer to them. And so it might make you feel better if you're a passive investor. I'm getting there. But the problem is what you're giving in long-term home price appreciation. And when you hold on for a market cycle, as we've talked about here, historical appreciation rates tend to repeat themselves. And I put a case study together where I talked about an investor who bought 10 rental properties in Cleveland versus 10 rental properties in Jacksonville and was able to document, based on actual appreciation rates, how they lost over $1 million of potential gains, specifically because they bought in a market that did not have strong long-term home price appreciation. So that's what I try to share with folks. If you invest for the long haul, you should pay attention to home price appreciation. It should be a part of the conversation. Because if not, if all you pay attention to is positive cash flow and you keep those blinders on, you're going to wind up kicking yourself after holding on for 10 years, 20 years. And you won't have made the best risk-adjusted return decision for yourself.
all right. That was a great breakdown. I hear in there that if you're going to stick to this arbitrary 1% rule, you're either going to have to give up appreciation, which is for long-term investors, the highest return that you're going to get, or you're going to have to give up the idea of being passive, right? Is it?
Exactly. There is no perfect investment out there, and there is always something you're going to be giving up, no matter what investment class. You just got to know what you're giving up, and you're exactly right. You're either going to give up the fact of being passive, or you're going to invest in a market where you're not going to get significant home price appreciation, and you'll be leaving a lot of money on the table there. So just know what's important to you and make your decisions accordingly.